It leads us to our talk of the tape. Is the tech exuberance fading? Let's ask Dan Greenhaus of Solus Alternative Asset Management. He joins me here at Post 9. Good to see you.
Thank you for having me.
Is the tech exuberance fading? It's been a strong run that nobody predicted year to date, month to date, and now some give back. Not extreme, but down for the week.
Not extreme, but every rainstorm has to begin with but a single raindrop, if that's what you believe.
So this is a rainstorm?
Yeah, I'm not saying that. The saying is apropos. I mean, listen, you've had a terrific run in a lot of these names, as everyone is well aware. Apple and on down through NVIDIA are up 30, 40, 50. NVIDIA is up almost 200% year to date. The law of large numbers kicks in at some point, and so it wouldn't be, whether in retrospect or at the moment, out of the realm of possibility to argue that most of those gains have been realized, and perhaps some give back or at a minimum a pause wouldn't be out of step with history.
So you don't think that you should buy the dip on NVIDIA because AI is transformational and we're just getting going?
Yeah, I'm making no comment about whether one should buy NVIDIA or not. What I'm saying is when a stock the size of NVIDIA, $1 trillion plus in market cap, is up 200% for a given year through 6 months, again, the law of large numbers says, are you going to be up 400% year to date? And again, we saw the data earlier today that showed that there were outflows of tech funds. There's concerns about interest rates and global central banks, obviously the Federal Reserve being more specific. And so when you put that all together, could we have some pullback during the summer? Sure.
It's all of them, though. I mean, this was a week dominated by news of central bank hiking.
That's right.
And it came as a double from the Bank of England in a surprise, came as a double from Norway, which I know people aren't paying attention to.
The threat from the Federal Reserve is a double?
ECB is promising more.
Sure.
Powell didn't say anything to dissuade us from more hikes. There you go.
There's a long list.
So maybe it was too good to be true that tech was rallying in the face of tighter policy and higher rates.
Well, yeah, I mean, but listen, I think the idea behind why you would pile into technology, let's say on the back of lower interest rates, is because you're discounting cash flows at a more attractive discount rate. But if you're Apple or NVIDIA, Meta, any of these companies, you're generating tremendous revenues, net income, cash flows today. So I think that argument holds a little less water on the active side of things than it does for, like, let's make it up, a Palantir or a Workday, let's say, where more of your value is going to be realized in the out years or the terminal value. But since we brought up the central banks, one can hide from the fact that central banks remain way more hawkish about inflation than does, or as appears to be, the market.
Yes.
The market continues to not believe what the Fed is doing. They haven't believed what the Fed will do for 6 or 9 months.
Market thinks there'll be one more hike.
I would argue, I mean, listen, most of the street is, from the economic side of things, appears to me to be at 0 or even 1. I think there's maybe 2 shops that are at 2 hikes. Citi, Andrew Hollenhorst is at 2, and I think our mutual friend Michael Gapin over at Bank of America is now at 2. Everyone else is at 0 or 1. But this has been the story over the last 6 or 9 months.
But the counter argument there is that they're closer to the end.
Sure.
And even if it's one or 2 more, bell's not going to ring when they're done.
That's right.
They're getting to the end. I think the bigger question is how long they stay at this high level and when they start cutting.
I totally agree with you.
And does that change your view on when you should be buying tech stocks?
Listen, absolutely. I think the idea that one more hike is the straw across the camel's back, sure, maybe there's some evidence there, but at the end of the day, we have no way of knowing whether 1 or 2 more hikes is it. But with respect to what you said, the longer you leave rates up at an elevated level, the more ocean you're chumming, so to speak, the more refinancings that are going to get difficult, the higher interest expense for on-the-bubble companies are going to be, the more projects or investments that get put off because your hurdle rate is elevated. And again, the longer you leave things up there, the more of that starts to accumulate.
Yeah.
And traditionally, that's ultimately, that more than one more hike is what tips the economy over into a recession. And if that is what happens over the next, call it 6 or 12 months, then you don't want to really buy anything on an absolute basis, let it be tech or industrial.